Hey everyone, it is Monday, September 26th. Today on the Final Bar, we'll talk about this continued choppy environment. The market moving all over. The end of the day, S&P down another 1%. We'll hit the market from three directions today. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of StockCharts. StockCharts is built on the discipline of technical analysis. We focus on tools, education, and commentary to help you along your journey. I hope we're able to highlight all three of those in some way on our show every day. Choppy environment choppy day among choppy days. I feel like netting out to another negative move and a lot of individual names starting to really break down. I think that's the most compelling point I can add to our ongoing list of bearish evidence that we've been gathering. Just to let you know what's coming up through the remainder of this week. It's a really good one. Tomorrow on the 27th, we have Mark Chaikin of Chaikin Analytics. On Wednesday, the 28th, Miss Schneider of Market Gauge. On Thursday, the 29th, Greg Schnell of Osprey Strategic. By the way, all three of those guests on the show this week will also be participating in ChartCon 2022. If you go to stockcharts.com/ChartCon, you can get all the information on this fantastic event coming up October 7th, 8th, just a week and a half away. We just recently added an updated schedule, subject to change, but you'll get a sense of all the great conversations we're going to have. Wanted to highlight today some of our fireside chats. Jay Woods will be sitting down with Ralph Acampora. Ralph literally taught Wall Street how to use technical analysis. Many of the institutional traders in the New York area took his course at the New York Institute of Finance. We'll hear how he is interpreting this week's and this year's price action. Gaddis Rose is going to sit down with his son Grayson, talking about all of the books that they have written together, the education they provided to investors in the Pacific Northwest. Great expertise on how to apply a trading plan and an investment plan to your own personal finances. Those are just two of two solid days of fantastic events. Sign up at stockcharts.com/ChartCon. Let's continue on our show today with our market recap. As I mentioned, a choppy environment. That's been the case. We've had elevated volatility. The VIX now above 30. Let's look at the evidence together now, see what we can learn about the market environment. As I mentioned in the intro, the S&P down about 1% today. That's to 3655. The NASDAQ composite down a little less than that. And for a little while earlier in the day, the NASDAQ was just narrowly in the green, finishing down about 0.6%. Mids and smalls both down 1.5%. Underperforming the S&P 500, and watch out because the VIX is now above 30. One of the most interesting data points I was following here in recent weeks and really months was the fact that the S&P rallied to the 200-day in mid-August, rolled over, but during that rollover period, the volatility, while elevated, while right in the mid-upper 20s, really hadn't gotten above that 30 level. We're there now, right? And the VIX has now gotten back above 30. And if you look back in 2022, every bounce, every buyable dip in the S&P, or every buyable low in the S&P, if you're a swing trader, has been marked with the VIX above 30. Let's look at that chart here really quick, and then we'll get back to some of the other charts to reflect on. Here's my VIX chart. It's part of my sentiment watch. Let's look at the chart we reviewed on Thursday's show. One of the comments on Thursday was markets selling off, but volatility, while high, compared to historical standards in the last couple of years, really not that high for 2022. It's almost mid-range, around 26, 27. Now spiking higher. Now, while a VIX above 30 doesn't guarantee today's going to be a bottom, it does tell me to start to look for signs of a bottoming phase. Right? And if you look back in March, if you look in May into the June low as well, every one of those times you had a VIX spike above 30 and sometimes get above 35. So there could certainly be some further upside. Could theoretically get well above 40 if things really start to crater. But it tells me to start looking for conditions of a market bottom. To be clear, we're not seeing them today by any stretch, I would argue. Keeping it macro here, because on Monday we like to hit three directions of market analysis. We start with macro, we then go to sectors, and then go to individual stocks. So continuing on this theme, we have a ton to talk about. Bonds continuing in a downtrend with the TLT down another 2% today. And one of the things we talked about a lot last week was how bonds tend to lead stocks in this sort of environment. Right? You're looking for a recovery from the bond markets first, if this would follow the general playbook for a market, some sort of market bottom. We're not seeing that yet today, obviously, with bond prices going lower. 10-year yields almost to 390, actually touched 390 earlier today. We're not far off. We're 1 day away, potentially, one not so big move away from 10-year yield being above 4%. Now, when we look at the chart of the 10-year yield, what you have to remember is, I think when you're looking at a chart of like $TNX, or one of those, you have to remember that it's all relative to the time frame that you select. So right now I'm looking at the last 2 years. So I'm going back to spring, a little more than that, right? 2.5 years, spring of 2020. And as a result, it looks like 10-year yield is obviously about as high as it should go, right? We're making new highs. It's well above the range that we've seen in the last couple of years. Doesn't this mean that rates have gone too far and that we're most likely going to come down? Now, this chart's going to look a little bit wonky, but you just have to go into a much deeper analysis, bringing in 25 years of daily data. So it's not the perfect chart. It's kind of noisy. But what you can see is that by historical standards, going back to the late 90s, rates are actually mid-range of where they've been over that period. And if the longer data we bring in, the more you recognize that even the rally that we've seen in rates, going from 0.5% to 3.5+% here in the last couple of weeks, that's still historically low levels. And the reason is because for much of that period, the bond markets were in a raging bull market until sort of the 2010s. That's when things started to lighten up a little bit. Rates eventually bottomed out in 2020 at the market low and again rallying. So if you're comparing now to 2 years ago, rates are pretty high. If you're comparing now to the last 20 years, rates are about mid-range. And if you're comparing now to the last 30 years, rates are still pretty low. So it's all relative. It's all relative to your time frame. I think a lot of financial analysis can certainly be that way. But I cringe when anyone says, boy, rates can't go much higher, can they? Because my answer is they can go a lot higher. And just look at the history to see examples of that. Commodities mostly in the red, by the way, with oil prices pushing down, the energy sector struggling. We're going to get to sectors here in a few minutes. Just want to point out that gold and silver continuing to push lower. And that's where a lot of people, given if I knew ahead of time that inflation was going to be such a challenge, I would automatically think gold is probably going to have a really good year. And it just has not been the case. It's a reminder that these things are not just simple relationships, right? If stocks do X, if inflation does X, if interest rates do Y, gold should do, Z. It's a complex system with a lot of different moving parts, and the strength in the dollar has killed the gold trade just beautifully in 2022. Cryptocurrencies, given all of the negative signs we saw from other asset classes, cryptocurrencies managing to have a fairly decent day. And by a decent day, I mean not going down for the most part. Now, 3 of the top 10 that we track are in fact down on the day, but Bitcoin up about 2%, Ether prices up about 2.5%. Now, both of those, again, struggling to regain any sort of footing after their recent drops. But for what it's worth, showing some minimal signs of strength here. Just to finish off, looking at a chart of the S&P, then we're going to move to our next segment. Just wanted to point out we did make a new closing low. We're very, very close to it. Now here today, actually we did, right? Because I think we're undercutting just barely that low. So new closing low for 2022 is not great. Now, this is obviously not just a one-day thing. This has been a drop that has been fueled through a number of days here in the last 4 to 5 weeks, coming off the August peak at the 200-day moving average. I think we're well past the point when you need to be thinking about further downside objectives. If you say, yeah, but we're oversold, doesn't that mean we're at a bottom? The answer is absolutely not. It means you could start to look for signs of a bottom. But if you look back in market history, when the markets really rupture, they often become oversold. Not overbought, oversold. They often become oversold, and not at the end. They become oversold earlier on in that trajectory, because when things really start to sell off, everything becomes oversold because it's so weak relative to what it's been in recent days and recent weeks. And that's why the oversold conditions can become magnified and very, very common in this sort of environment. So having said that, I think the break of 36.35 which would be very, very close. If we get below that level, that's the horizontal level you see there. I think that opens the door very quickly to further downside targets. 3,200 is the eventual target. We've been talking about using Fibonacci analysis. We need to continue on with our next segment, sector setups. We talked about the big picture. No doubt risk assets are going down, bonds going down. One of the few things going higher, two things going higher, the dollar and interest rates. Those are pretty much moving higher very, very well. Everything else seems to be, in general, going lower. But having said that, talking about sectors is important because sectors for a lot of investors are more of a relative game, right? If you can be rotating consistently into sectors that are working, sectors that are outperforming overall, if you do it right, ideally you could outperform a passive benchmark, which is essentially, really keyed into the growth sectors. That's the reality of the markets in 2022. A handful of sectors which are very growth oriented, particularly consumer discretionary, technology, communication services in some ways. The mega cap names for the most part are in those sectors, which means with a very growth oriented benchmark, if you can be in value when it pays to be in value, ideally you can weather these sorts of storms. And also the value oriented sectors tend to have a more decent income component, more decent dividend component, which is something the growth sectors tend to struggle on. Let's look at what the RRG tells us about the rotations here in the last couple of weeks. Here's technology, which is still in the leading quadrant, but has rotated from northeast, the direction of improvement, to southwest, the direction of deterioration. If we rewind, we're looking at the XLK right here. But at the August highs, this is what it looks like, right? Technology, the only sector in the leading quadrant, starts to improve. But look at what's happened in the last 5 or 6 weeks. We've seen it rotate southwest, right? Heading in a negative direction. Consumer discretionary had been heading northeast, now heading more southeast, slowing down. Look at how energy, which is way off the viewable area, kind of coming, ripping to the due north here. Utilities rotating in a more positive direction. Same can be said for consumer staples and healthcare. I'm not finding a lot of stocks that make me, really excited about taking on additional risk here. I think I've probably made that pretty clear in the last couple of weeks on the show. And I know with my market misbehavior premium members, we've been talking a lot about defensive positioning, about really limiting opportunities or limiting exposure to risk at this point, because the charts really don't tell you that that's a great opportunity at the moment. Having said that, if you have to be in equities, right? If you're an advisor and you need to have an equity allocation, that's important as part of the structure of your process, I think there are areas where there's outperformance. Utilities stands out as one of those defensive areas of the market, actually holding up very, very well on a relative basis and starting to see some renewed strength. When everything feels like it's selling off, look for those places that are selling off less. And I would argue you're finding that in things like utilities, consumer staples, and healthcare stand out certainly as those general sectors where you're seeing some renewed relative strength. Having said that, let's look at the 11 S&P sectors using the candle glance function. Again, this is a great way to take a bunch of charts, kind of throw them on your monitor at once. You can make this page really, really small. And on the Mac, you hit the command key and hit the minus key. You can see where you could put 100 charts on your screen if you wanted to. There's probably a little more than you might want. So I usually keep it to like 12 or 15, but it's a great way to just look at how these sectors are doing relative to one another. So my question number one, how many of the 11 S&P sectors are above their 200-day moving average? Unfortunately, after today's trading, the answer is 0. Energy and utilities have been two sectors holding up, continuing to hold up, while everything else well below their 200-day. Both of those have actually broken down through the 200-day moving average. This is the chart of energy, which had been setting up. You can see the notations I put on here a couple of weeks ago, seeing that higher low in early September and commenting that if we still get that pattern of higher highs and higher lows, it's actually a pretty constructive chart. Maybe energy just does really well while everything else struggles. That's what happened in the first half of 2022, right? That is no longer the case, right? And you can see by the fact that we made a lower high with the XLE stalling out around 82. This is about a week and a half ago. And then from there, rolling over. So instead of making higher highs, we start making lower highs. Instead of making higher lows, we're now making lower lows. And so this is really changing the configuration of the XLE. Just in the last couple of weeks, you've seen that rotation. So what do you do with a chart like this now? Well, you have a really interesting Fibonacci level at 64. That's almost exactly where the market stalled out on its sell-off in July, right? So XLE made a new high in June, actually pulled back about 38.2% of the way. using the recent framework that we've talked about, and now all of a sudden we're bouncing higher into the peak in August. Now rolling over, we hold 64, still not a bad chart. We break that. This gets really ugly really quickly. Utilities is a sector I'll highlight as well, and again, not my favorite chart on an absolute basis. I totally get that. No, I'm not a fan of it stalling out, making a double top. No, I don't like when it breaks down through the moving averages, but on a relative basis, if you just owned utilities for the last year, we'll call it, you outperformed the market just handsomely, just by owning a defensive sector like utility, a value-oriented, low volatility sector. This is an important, it's always a good time to look at relative strength, but I say especially now when it feels like everything's selling off, focus in on those areas in the market where the relative strength lines are still improving. That's going to help you at the very least minimize your losses or minimize the pain on the way down and give you an opportunity to leg back into the offense when the charts tell you it's time to do so. Let's take a quick commercial break. We'll be back with my next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. So appreciate you joining us every weekday after the close as we break down this environment using the power of StockCharts, using the technical toolkit to better understand the markets around us. A couple quick announcements before we get to my next segment, Shifting Stocks. We welcome your questions. We're going to do a mailbag segment on tomorrow's show on Tuesday and another one at the end of this week. Those questions all come from people like you, running into things on stock charts, running into questions as you use technical analysis. So we are here to help you. Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. And we're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. Hope to answer you live on the air on Tuesday. Also go to StockChartsTV.com. I mentioned some of our guests this week, Mark Chaikin, Mish Schneider, Greg Schnell. All three of them have done special events on Stock Charts TV in the last year. All three of them have appeared on some of our special events like The Pitch, our Market Outlook specials. All of that fantastic content every trading day is available for free to you at StockChartsTV.com or on your mobile device. Just search for Stock Charts TV on demand. Let's continue on. We started big picture, talked about the macro environment. We went through the sectors before the break, talked about some relative strength in areas like energy and utilities, and why to focus on relative strength is key. I think in any environment, particularly in this one, it feels like everything is going down. Let's talk about some individual stocks from here on out. And I'm remembering one of my analysts at Fidelity, Bill Diani, who's no longer with us, unfortunately, but a really bright young analyst, and his father was the technical analyst at Wellington Investments in the 1970s in Boston. I got to know Bill when we were dealing with the 2008 financial drop, the financial crisis and the drop 08 into 09. And we talked about how important it was in sectors like healthcare and financials. If you want to figure out where to be, just focus on relative strength. Even ignore the price and just look at the relative strength and see where those opportunities are. At the least, it's going to make sure that you're in the things that are going down less than other things. And that, in a lot of times, can be a real saving grace in a choppy environment. Having said that, let's look at a bright spot here. Amazon. I don't know if I would generally describe Amazon as a bright spot, but I did find something with an interesting chart pattern that I'll share with you. So a lot of people asked me on Friday about hammer candles, and I just wanted to highlight the chart of Amazon. Just talk through this for a minute. Amazon is one of those, the SPYs, the Qs, the IWM. They all kind of had similar type of candles, right? Where it's sort of like the it almost looks like a handle. And when hammer. Someone asked me about the spiders as one of my premium members over the weekend. And what I told him was, look, it's kind of a hammer. I would call this a hammer-like candle, which does not mean a whole lot to me. And here's the reason, right? When you're thinking about something like a hammer candle, we are actually programmed as humans to see a lot of patterns. We are very good at pattern recognition. It's one of the ways that I think we are naturally designed that way or have evolved that way so that we don't lose our minds in an incredibly diverse world with so many different inputs. By, finding patterns, we're able to relate things to one another. We're able to actually make sense of things and navigate this incredibly diverse world that we all live in. So unfortunately for us as technical analysts and as traders is that we are wired to see way more patterns than actually exist. And you'll find that if you bring up a chart and try to find patterns, you will find things that are like, oh, that might be a flag, oh, that might be a hammer, when a lot of times it really isn't. So you have to go back to the great writings in technical analysis, right? The textbooks. Look back to comments by John Murphy and Martin Pring and Charlie Kirkpatrick and Julie Dahlquist and Steve Nissen and others who have written about, Steve Bigelow, who have written about candlestick analysis, and focus on the rules. And what I learned about hammer candles is you really need the open and close to be near the high of the day. You need a little to no upper shadow, which this one definitely has. You want a long lower shadow, but it has to be long relative to the size of the body. And unfortunately, I don't really see that with something like the SPY on Friday. And I certainly don't see that on something like Amazon, where the head of the hammer actually takes up about half of the day's range. That's too much, right? It needs to be very, very small at the upper end of the range to really qualify, I would argue, as a hammer candle. Now, there's definitely wiggle room, and it can really, a lot of times, can even come down to how you have your charts formatted. So it's not a hard and fast rule, but it's just my experience and making sure that you limit it to the really good examples. Having said that, today's candle is actually creates a 2-bar bullish candle pattern, which is called a bullish piercing line. You may have to go to the readings on that, to the literature, to remember what that is, but here's what it is. A bullish engulfing pattern would be a big down day, a lower open on day 2, and a higher close where it closes above the second day's open. That's called a bullish engulfing pattern. A bullish engulfing pattern that doesn't quite make it above the open of day 1, but does make it at least 50% of the way up through the first day's body is called a bullish piercing line. The opposite of that, if you have a big, in an uptrend, you have a big up day and then a down bar where it doesn't quite get through the first candle, but gets at least halfway down through. That's called a dark cloud cover. Same thing. It's a bearish candle pattern. So this is a bullish 2-bar candle pattern. The natural stop would be the intraday low of that 2-bar pattern, which would be around 112. So while again, I'm not super excited about taking on risk in this environment because I feel like there's much more. I think the path of least resistance is down in a big way for stocks. Looking for signs of opportunity like this, and looking for and keeping an eye on where the risk would be defined, I think is important. So looking at this as a short term, next 1 to 3 bars most likely higher, but a break below 112 would negate it. That's one way to think about Amazon, given the candle pattern that I shared. There are a lot of charts out there showing bearish divergences. I'll show my sort of classic chart for this. I was looking through a series of charts over the weekend. I like to look at the entire S&P 500 when I can. I was finishing up this morning, and one of the charts that I looked at was ROST stores, and it struck me just a brilliant illustration of this current environment. ROST stores in early September looks like a rock star chart. The relative strength improving for about 6 to 8 weeks, making higher highs and higher lows, finally getting above the 200-day moving average, even closing above the high for August. And I'm thinking at this time, all right, everything's coming off, but some of these areas of retail, believe it or not, are actually starting to improve, right? Are making new swing highs. We're getting above the 200-day. Should I be concerned that we've stalled out just above the 200-day a number of times in the last year? Probably shouldn't be an issue. We'll just ride this higher. One of the key points to look at here when you're breaking out is to look at the price momentum. This is just a classic example of a bearish momentum divergence. Higher highs in price, particularly on a closing basis, lower peaks in RSI. And this one's even more ideal because you have overbought on the first time, not overbought on the second time. So it shows you a bunch of buyers coming in on the first attempt. As we make the second attempt, we make a higher high, but less momentum. That sort of indicates a stalling out of the bullish sentiment. Sure enough, we've now broken down quickly in the last week. It's gone from looking okay to looking kind of rough because we undercut that swing low there in late August. The RSI now below 40, which is more characteristic of a bear market phase. So I think ROST stores sort of illustrates pretty beautifully the environment that we're in, and unfortunately, it's not particularly bullish. Seeing the same thing with Chipotle. We highlighted Chipotle in August and September, particularly when it's making new swing highs. This was part of the recovery thesis was, all right, charts like CMG and ROST stores and these other names that are working, Tesla, rolling up to the upside, these need to keep going. You need leadership names that are pushing higher, then eventually everything else catches up. What's happened is the opposite. The things that were lagging behind are now really breaking down to new 52-week lows. And the stuff that had been leadership, like some energy names like Chipotle and others, had a bearish momentum divergence, overbought on the first peak, not overbought on the second peak, now breaking below moving average support, breaking below the most recent swing highs. So ROST stores and Chipotle, two consumer discretionary names that went from very attractive about a week and a half ago, but really starting to confirm, I would argue, more of a risk-off phase that we're most likely in here. Just a couple other, thing. If we're looking for, so what looks good, right? Out of anything, is there anything that looks good out there? I'd highlight a chart like O'Reilly's. And again, to be clear, as I mentioned to my premium subscribers on Saturday when I write my big weekly report, I'm not a big fan of being risk on in this environment. This is the type of environment where I think you are defensive, where you raise cash, where you hold things that are still working, but unfortunately not a lot still working at this point. And this is the time to reassess. Eventually, when the markets go down so much, if they would continue to really rupture, things get really exciting, because at some point it ends up being down so much from the highs that if you have a long enough time frame, you'd be silly not to start taking on a ton of risk and ride the next move higher. What concerns me is that there's a likelihood that we go further down from here. Chart like O'Reilly's might be an interesting one to highlight. Sort of a double top pattern, right? You had the April peak, you had the August peak. We've come off of that level. We're settling in around 680, and we've bounced off of that level a couple times, just above the 200-day moving average. The RSI holding above 40, and since it's holding support and it's holding momentum, the relative strength is improving because the average stock is really breaking down in the last week. Look at how it's actually gone up on a day like today, while most things are actually going lower. This holds 680. This holds the 200-day moving average. Not a bad chart, and maybe one of those leadership names that is able to outperform. But again, what most impresses me is, even though it's not the perfect chart on an absolute basis, the relative strength is going up. And just as a close, if you can just focus on names where relative strength is improving, that is how you can navigate this type of market way more effectively than if you ignore the message of relative strength. We have to wrap this show, folks. Go to the 3 and 3. Let's hit on 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. I was asked over the weekend, someone asked, is anything going up, right? Give me something that's bullish. And my answer were 2 things: the dollar and rates. And being bullish on rates is a little rough, right? Because it's the inverse of the bond markets, which are, continuing to go down. But if you're looking for a chart that is ripping to the upside, the dollar is it. Now, it's really accelerated in the last couple sessions, where you think about the average risk asset like equities have rolled over in a big way in the last couple sessions. You can see how the dollar is ripping to the upside. The US dollar bullish ETF, which is ticker UUP, became extremely overbought on today's close. Now, we would often say in my previous life at a money management firm, we would call this the good overbought. When the RSI gets above 70, it oftentimes is a sort of a short-term reversal sign, right? It's sort of gone too high too quick. You'd expect a short-term pullback, particularly when it comes out of that overbought region. But an RSI above 80 is extremely overbought, which means the momentum is so strong, and most likely, even if you do get a brief pullback, it usually means that there's more upside to be had. So the dollar index, which has really moved inversely to risk assets in most of 2022, continue to sort of press the long side and pushing ever higher. It's hard to imagine that stocks are going to do particularly well until this chart stops going higher, and it did not stop today. Chart number 2 is the chart of India. I was looking at the Sensex index earlier. For a lot of US-based investors, INDA is an ETF that gives you a general exposure there. The Sensex $SEN SEX is a good benchmark for the Indian equity markets. But for, again, as an ETF, INDA is the most liquid ETF that I've used that sort of tracks that space. Unfortunately, very similar to the charts of ROST stores and Chipotle and others. If you asked me a month ago, what international market should I own if I had to own one? My answer would probably be India, because it's been one of the better performing ETFs, and the relative strength in particular since mid-August has done very, very well. It's actually rolling higher while the S&P was struggling, coming off of that August peak, made a new high in early September. From there, though, just like those consumer discretionary names, rolling down to the downside. I'm actually heading to India in early November to speak at a conference. I'm super excited to get back to Mumbai and share some technical wisdom as much as I can. Finally, the chart of the 10-year. As a reminder, when you see the chart going to new highs or new lows, bring in way more data. This is the 10-year yield going back to 1993. You can see how we're still essentially at the midpoint of where we've been for the last 25 years. There could be more upside in rates. That's all I will say. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close. All our previous discussions are at StockChartsTV.com. For StockCharts in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.